Good morning, everyone. Thank you for joining me for today's session. My name is Eva, and I'm the investment consultant to the Sygnia Umbrella Retirement Fund. So what I'll focus on today is, in addition to covering the usual performance, which will be up until the end of June 2020, I'll talk through the performance. I'll show you how the various portfolios have done over the period. But in addition to that, I want to focus a little bit on fees, how fees work, what the different fees are in the industry, and it's always important for us to know when we're looking at fees that we're comparing apples with apples. So before I get into it, just a reminder on what our vision statement is at SURF, so the Sygnia Umbrella Retirement Fund. So when we created this product, we created it with a mission to be able to restore confidence in the retirement fund industry. And ultimately, the goal for us is to be able to assist members to retire comfortably. So to be able to save enough money throughout their working life in order to be able to retire within our funds to live a comfortable retirement. So what I'll cover today is, as I mentioned, I will go through the performance. Before I get into the performance, I will cover just a quick reminder of what the investment strategy of SURF is, and then I'll go into investment fees, and I'll explain what the different fees are. And once I've explained that, we will then look at what SURF's fees are. So we'll look at them, and we'll look at what the various portfolios cost, and hopefully it will all make sense after I've explained what the different layers of all of the fees are. So just as a reminder, the investment strategy of the fund is a life stage model. So the default strategy is that members will go into a life stage model, meaning that younger members will be invested in portfolios that are slightly more aggressive, as they have a long time horizon before they retire. And then your older members that are closer to retirement will be invested in a more conservative portfolio. So a life stage model works in such a way where we, as the administrator, would be switching members from a more aggressive portfolio to a more conservative portfolio. We have everybody's details. We know how old members are. And the idea is that a member that enters into a life stage model doesn't need to actually actively do anything, but we will take care of the investment strategy throughout their working life. We do appreciate that life stage models are not for everybody. So some members have their own individual circumstances that might be quite unique. And for that reason, we also provide members with member investment choice. So at any stage, a member can switch out of the life stage model and go into one of the other portfolios. We, of course, encourage members to obtain financial advice before doing so. And the fund will not charge members for switching. And in addition to that, members are able to switch as often as they would like to. Of course, again, we encourage financial advice and we encourage long-term investing. So the portfolio, the life stage models works as such. Right up until 6 years before retirement, members will be invested in the 70 portfolios, meaning that they would have about 70% allocation to equities. Then from 6 years to retirement, as they get closer and closer to retirement, we will transition members' monies into more and more conservative portfolios, as you can see at the top of this chart. Now, the default is the life stage model, but every employer can then choose which life stage model to go into. So all three of the life stage models follow the same glide path, whereby they start de-risking members from 6 years before retirement, but the underlying portfolios are slightly different. So on the passive side, we have the skeleton range, and in this range, we are not using any active managers. Then we have a blend of passive and active, which is our signature range. And then our third range, which is called the synergy range, is whereby we have some active managers on the local side deciding on the asset allocation, and then we control the global portion. By we, I mean Sygnia Asset Management. So the global portion of all three of these portfolios is exactly the same. So just a reminder again of the differences structurally between these three ranges. If you look at the skeleton and the signature range, these are what we call specialist portfolios. So if you look at the little diagram I have on the left-hand side of the slide, how this works is that Sygnia decides on the asset allocation. So we model these portfolios, and the model will tell us, for example, that we should have about 48% in equities and X amount in bonds, X amount in cash. And then once we know how much equities we want, we then go out and see what is the best way to implement this. So in the skeleton range, we will then look at what is the best index to track for these equities. In the signature range, it will be a blend. So what indices do we want to use, and what managers do we want to use for this equity building block, and so forth. The synergy range from a construction perspective is quite different. So it's what we call a balanced approach to portfolio management. So how this works is on the local side, so the 70% of this portfolio that's invested locally, we split that between various managers. So we give a portion to Investec, we'll give a portion to Ford, we'll give a portion to Allen Gray, whoever those managers may be at the time, and I'll show you exactly who they are later. And we say to these managers, Investec, you have X amount, please manage this within the restraints of Regulation 28, and it's up to you how much you want to invest in equities, in bonds and cash, and we of course give them a mandate with some broad guidelines. But at any stage, we only know at month end where the portfolio was actually invested. So these managers are able to rotate out of bonds into equities and vice versa, should they wish to do so. And then the global portion is exactly the same between the skeleton, signature, and synergy range, which Sygnia Asset Management then manages. From a risk and return perspective, as we know, the theory tells us that the higher the risk, the higher the return. So if you're willing to invest in some riskier assets, such as equities and global assets and property, then theoretically over the long term, you are rewarded for taking on that risk, and you can expect a higher return. So all of our 70 portfolios are on the higher risk spectrum, but you're expected to have a higher return over the long term. And then for the members that are closer to retirement, they'll be invested in the low risk portfolios, which is our 40 funds, our signature, skeleton, and synergy 40 funds. And there the risk is lower because there's a lot of bonds in those portfolios, there's a lot of money markets instruments in those portfolios, but your return expectation is also lower. And the idea is that you don't want a member that's close to retirement to experience a shock in the markets and to actually retire with less money than they thought. So from a strategic asset allocation perspective, so what is the strategic asset allocation? The strategic asset allocation is our long-term view of where the portfolio should be invested. So if we look at our 40 funds, for example, from a long-term perspective, we believe that the mix of assets should be about 25% in equities, 26% in bonds, etc. So once we've decided on the strategic asset allocation, this is the long-term mix of assets that the portfolio should have, we also tilt that on a short-term basis. So things happen in the markets. For example, at the moment, we find ourselves in the midst of a global pandemic. There's a lot of assets that are set to perform better than others. So on a short-term basis, we also make some tactical moves. But on a long-term basis, this is where the portfolios are set to be invested. So how have the portfolios performed? Well, it's important to look at the portfolios on a long-term cumulative basis. And what's the first observation when we look at the slide is that there's growth, yes, but the growth is not smooth. So your assets are not growing in a very smooth line, but there is volatility along the way. So this volatility is very normal and it's very expected, and the longer the graph, so if you look at it over 50 years or over 40 years, which is actually appropriate for a retirement fund, as you start working in your early 20s, retire in your early 60s, if you look at it over a longer term, these lines actually do look smoother over the longer term. But there is a lot of volatility when investing, especially in equities and in global assets. And what's quite obvious to see on this specific chart is if you look at it towards the end, so if you look at it between January and May of 2020, you see that sharp drawdown and then that quick recovery again. So this is exactly what we've seen in the markets this year. So we saw a large sell-off in February and in March when the whole world started going into lockdowns because of the coronavirus. And markets both locally and globally were very hurt. We saw some of the worst days in a lot of stock exchanges history. We saw those sharp drawdowns in March. But then when government started to respond to this pandemic with some assistance in terms of monetary and fiscal policy. So government started to respond to the crisis and to say, we know that we're forcing everybody into lockdowns, but we will support. We will cut interest rates where we can. We will go into a bond buying program. We will have these massive fiscal packages to assist businesses with, be it interest-free loans, be it assisting people with grants. So based on that support, markets then started to respond, and we can see that quick recovery that we have seen in the market. So you see that almost V-shape towards the end. And that again shows us that, yes, we do invest in equities. It's not a smooth return, but over the long term, you are expected to grow your funds by being invested in risky assets. So what you'll see here is that over this period, the Signature 70 fund has outperformed the Synergy and the Skeleton on the cumulative basis. And what's also important is to look at the black line, which is the Global Large Manager Watch median. So what is that? So this is a well-accepted benchmark in the retirement fund space. And it's the median performance of the largest managers in South Africa who are listed below. So it's the median performance over time between Alan Gray, 91, Coronation, Ford. So all these very well-known managers submit their performance every month to Alexander Forbes, who prepares the survey. They take the median manager every month, and if you plot that, it's a well-accepted benchmark in the industry. So a bit of a busy graph here, and I'll point out a couple of things, but this is the investment performance across all the ranges up until 30 June 2020. So what you'll see is if you look at just the June column, we see that June was a positive month across the board. We also see that your 70 funds, so the ones at the top, have performed better than your 40 funds, which is exactly what you expect to see. So you remember in theory, we looked at it a bit earlier, and the higher the risk, the higher the return. So these 70 funds are taking on slightly more risk, and they've been rewarded for that risk. The 3 months numbers, so this is April, May, and June. So April, May, and June, already by then markets had recovered, and you can see some really nice double-digit returns for the 3 months. Look at the 1 year column though, and in the 1 year numbers, you have those February and March numbers that I spoke about a little bit earlier. So those negative returns are filtering through still to the 1 year number. And if you look at the 1 years, this is not what you would expect to see over the long term, but it's very typical over the short term when we're experiencing turbulent markets. So if you look at the Signature, Skeleton, and Synergy 70 funds, so your more aggressive portfolios have actually done worse than your 40 portfolios, for example. So if you look at the Skeleton 70 fund, giving you 5.5% over the 1 year, versus the Skeleton 40 fund, giving you 7.2%. So in a turbulent market, this is an outcome that is good in the sense that younger members that would have been invested in the 70 funds, they've got time to go through the ups and downs, whereas your older members invested in the 40 funds, they have been protected, they've been invested in bonds, in cash, in your safer type of assets, and these portfolios have actually done better over the 1 year. But if you look at it then over the 10 years, again, the market has corrected to what we would expect to see, and we see that our 70 funds have performed better than our 40 funds. Then the single managers. So as I mentioned a little bit earlier on, members can also opt out of the life stage model that the employer has chosen for them, and they could invest into one of the single manager portfolios. And here you can see the performance of those portfolios. So over the 1 year, you'll see that there's quite a big dispersion in returns between the various portfolios. So if you look at Alan Gray, for example, giving you just under 3% versus a Ford giving you 10%. So the dispersion is huge. And we do expect to see this from single managers. So single managers typically have slightly more concentrated portfolios than the balanced multi-manager portfolios that we manage. Single managers also tend to differentiate themselves by having very strong views in terms of style. So some managers are very into buying underpriced stocks. So like an Alan Gray, for example, they are a value manager. They will only buy a stock if they believe that it's undervalued. So if they believe that Woolies, for example, should be at 65 Rand and they see it at 35 Rand, they're going to say, well, this is great value for money, I'm going to buy Woolies. Whereas you get other managers that follow a very different style. They kind of follow the trends. So if a stock continues to go up, even if it's overpriced, they will, they may still buy it because they still believe that that earnings momentum will keep going up. So you get different managers that from a philosophical perspective have different views as to how they want to manage money. And that's why you see this dispersion in their returns. So Ford, for example, in this stage has invested a lot into gold, and gold has done very well over this period. Whenever we find ourselves in turbulent markets, be it because of a pandemic or another type of banking crisis, when investors aren't quite sure where to put their money, they're not quite sure whether the US market or South Africa or any other emerging market is a good place to be, they then take their money and they put it into gold. Gold is always seen as a safe haven physical commodity, and they've done very well because of that. Now, when we look at the surveys, so it's important to firstly understand the portfolio that you invested in, what it's trying to achieve over the longer term, but it's also good to look at how it fares against competitors in the market. So again, these surveys are prepared independently by Alexander Forbes Investments, and what happens is every month the various investment houses in South Africa that manage these type of portfolios will submit their returns to Alexander Forbes. Alexander Forbes then prepares these surveys by comparing similar managers. So it's not fair to compare a manager that's managing a low equity type of portfolio, so a manager that's focused more on bonds and money market instruments. It's not fair to compare the performance of that manager to a very high equity manager. So how these surveys are prepared is that we're comparing like for like. So in this survey that we're looking at on this slide, we're comparing our 40 portfolios to other portfolios in the industry that all have roughly 40% allocated to equities. So from an asset allocation mix perspective, they should all be quite similar. And we can see that the Skeleton 40 Fund has been the top performer over 1 and 3 years, and then our Signature Fund is the top performer over 7 years, and again over 10 years. So the way to read these numbers as well, so if we look at it over the 10 years, the Signature 40 Fund has given us 11.3%. This return is annualized, meaning that had you been invested in this portfolio over the last 10 years, you would have received a return of 11.3% per year for the last 10 years. So really great performance in the low equity space. If we look at the low and medium equity space, so this is where our 50 funds are. So all of these portfolios have about a 50% allocation to equities. We can see that the Skeleton 50 Fund is the top performer over 1 year, over 3 years, and then the Synergy Fund has been the best performer over 5 years. Looking at it over the longer term, the Signature 50 Fund is the best performer over the last 10 years. What you'll also notice is that there's less competitors in the 10-year space. So why is that? Not everybody has a 10-year track record. And that's why there's less portfolios to compare against over 10 years. Then the 60 funds, so all of these have about a 60% allocation to equities. We can see that again, top performance out of the life stage portfolios over 1, 3, and 5 years, and then over 10 years, again, top performers relative to competitors in the space. And then the most important portfolio of all is the 70 portfolio. Why I say it's the most important portfolio, because we find that majority of members do follow the life stage model, and they are invested in these 70 portfolios for the majority of their working lives. So to give you a practical example, if I started working somewhere in my early 20s, and I never made an active investment choice, I would be in this portfolio right up until 6 years before retirement. So we expect members to spend, more than 30 years investing in this portfolio if they join an employer young. So this portfolio is important, as most members will be invested here for a long period of time. So top performance, the Skeleton 70 fund that has given us over the 1 year. Over the 3 years, it's again the top performer. The Synergy Fund is the best performer over 5 years, but then looking at it over 7 and 10 years, we can see that the Signature 70 Fund has given us the best performance. So over the last 10 years, had you been invested in this portfolio, the return you would have received is 12.5% per year for the last 10 years. It's also important to compare against the single managers. So I've already mentioned that single managers do tend to have more concentrated portfolios, stronger styles that come through. And for that reason, we don't expect one single manager to outperform in every market environment. So it's unlikely that over 1, 3, 5, 7, and 10 years, you'll have the same person at the top. It's unlikely that you'll see Ford being, over the 1, 3, 5, and 10 years. What you tend to see with single managers is that, depending on the market environment, when it's favorable for them, they will outperform, but when it's unfavorable, they tend to drop down on the ranking tables. So it's important to also compare our portfolios to the single managers, and you can see that we are behind Ford on the 1 year, top performance over 3 and 5 years, and then again, top performance over 7 and 10 years. So you can have comfort that despite which life stage model you've chosen, that across the board, these portfolios have done very, very well against everybody else in the market. From a risk and return perspective, it's also important to look at how much risk your portfolio manager is taking. We obviously don't want our monies to be invested somewhere where the portfolio manager is taking on too much risk, because risk is, of course, it can be a bit uncomfortable, because then you might lose, a certain portion of the investment if it's managed in an irresponsible manner. But from a risk and return perspective, the way to read this chart is if we're looking at the horizontal axis at the bottom where we have risk, the further right you go, as the numbers go up, it means that the portfolio is taking on more risk, meaning that now it's invested in more risky assets, so more equities, more offshore assets, more property, for example. And on the vertical axis, we then have the return. So the higher the risk, typically the higher the return. So that's why we see, for example, the Signature 70 fund, which we saw was a top performer in the surveys. We can see that it's taken on about a 9% risk. So anybody that's under that portfolio on the chart has also taken on 9% of risk, but they've provided us with less of a return. So for example, if we look at this Momentum Flexible 6 or the Sanlam MM60, those portfolios have also taken on 9% of risk, but the return they've provided, if you look at where it matches on the vertical axis, the return is lower. So overall, basically how to read this chart is for every level of risk, you want the top performing portfolio. And visually, we can see that against competitors, these portfolios have done very, very well, and they've taken on a reasonable amount of risk for the return that they have provided. So now that we've covered performance, and we've looked at how the portfolios have done up until 30 June 2020. I want to focus a little bit on fees. So fees is something that is quite misunderstood in the investment industry, but it's also something that hasn't been very well disclosed by the industry. So why are fees important? Well, firstly, fees are important because fees directly impact your return. So to give you like a broad example, we could have two portfolios. They both give us 10%. For the year, but the one portfolio is charging 1%, the other portfolio is charging 3%. On a net fee basis, of course, you would have been better off in the lower fee portfolio because the return that you actually receive, so your true experience being invested in your portfolio is actually the net fee experience. So, yes, it's important to look at the gross returns, but the net fee performance is really what matters to each individual. So the higher the fee, the less you actually get on your statement, your personal return. So this is a chart that we've used in a number of webinars, so I'm not going to spend too much time on it. It was prepared by National Treasury, but it shows us that how when you reduce fees, you really can, because of the effects of compounding over the long term, you really can make a very big difference to your savings over the longer term. So it's important to have a low fee but high performing portfolio. So when we look at fees, firstly, every single investment out there has fees attached to it. So whether you're buying a single stock, so if I log onto my stockbroking account that I have through my bank and I decide that I want to purchase a little bit of Naspers and a little bit of Woolies directly, so I'm going directly now through my stockbroker to purchase a share, that share might cost, 1,000 Rand, for example, but there will be, I won't just pay the 1,000 Rand, but I will pay some extra fees. So there is fees in trading. So you have fees whether you're buying a single share, you have fees whether you're going into a unit trust, the retirement annuity fund, and likewise by being invested in a group retirement fund, there are also fees that are attached to your investment. But what's important is firstly to understand the fees, and secondly is when you're comparing fees is to compare apples with apples. So you're not comparing one type of fee to a different type of fees, to compare apples with apples. If you're looking at management fees, then compare management fees on both sides. If you're looking at total expense ratios, then compare the exact same thing on both portfolios. So the different fees that I will cover are the fees that are relevant to retirement fund investing, and we'll look at the management fees, which we call participation fees in SURF. We'll look at total expense ratios, and then we'll look at total investment charges as well. So what are management fees? So management fees, and again, that's what we call participation fees. So if you look at various documents from SURF, we refer to them as participation fees. But this is really the fee that an asset manager charges for managing that portfolio. So these fees can be expressed as a percentage of assets. Sometimes they're expressed as a percentage plus something that's performance linked. Sometimes it's one or the other, and often it's a combination of the two. So sometimes it might just be, 10 bips for 10 basis points of the asset value. Sometimes it might be 10 bips plus 20% of any outperformance. So if your manager hits the benchmark and outperforms even above that, then they may take some what we call performance fees. But as I mentioned a little bit earlier on, when you're comparing management fees, if you look at two fund fact sheets, it's important that you're comparing like for like. So that terminology, management fee on this portfolio versus the management fee on this portfolio. But typically in South Africa and in the retirement fund space that we're used to, we are reporting management and participation fee as a percentage. These fees are ongoing. So as an example, if you have a portfolio size of 1 million and the management fee is 25 bips for 0.25%, you multiply that and you actually paying 2,500 Rand per annum if this is your management fee, and it typically gets charged monthly. But this isn't the only fee. So management fees aren't the complete fee that as a member of the fund you are paying. There's other expenses on top of the management fees that rack up. And this is where in the retirement fund space, a few years back, it was a very grey area where it was never legislated that asset managers had to report the full fees. And it was quite difficult to actually compare two portfolios on a like-for-like basis. So the total expense ratio then takes the management fees plus a few other charges which I've listed below. So it's a more fair representation of what your portfolio actually costs you. Because as I mentioned, it's not just the management fee that gets deducted from your return that to give you the net of fair returns. There are other fees. So the total expense ratio takes your management fee plus these other charges. So in addition to the management fee, if we then add the bank charges, because of course, there's bank accounts that your contributions and your investments are going in. So the funds also have audit expenses. So if you look at the audit fees, there's some taxes that may be applicable in certain instances. Then you have custodians and trustee fees that also come off that. There's costs related to script lending if the portfolios do script lending. And then, of course, there's performance fees. Performance fees are not fees that affect every portfolio. So as I mentioned a little bit earlier, these are fees that managers charge for outperforming the benchmark. So looking at Ford a little bit earlier on, we saw that they had stellar performance. They've given us 10%. If their benchmark was, for example, 5, then they've outperformed by 5%. Then they may take additional fees on that outperformance. So firstly, you've beaten the benchmark and you've gone quite a bit beyond that. There may be some fee to reward the manager for outperforming. Typically, performance fees, there's big debates in the industry whether they're good or bad, because some may argue that if the manager really does give you this phenomenal performance, then he deserves to, charge a few extra fees for that. But then, when they underperform, unfortunately, the opposite is not true. If they terribly underperform, they're not going to pay you out and say, you know what, actually, let me give you some money back because I've done terribly. But, as I mentioned, there's a lot of debate whether performance fees do have a place or not in investment management, but be it as it may, some managers do charge performance fees, and that's why that's also included in the total expense ratio. So it's a more fair comparison to compare, fund X's total expense ratio versus fund Y's total expense ratio. That's a more meaningful comparison than just simply comparing the management fees. But that's not all. In addition to all of these fees, you also have transaction costs. So transaction costs are the costs to actually transact. So it's, as I mentioned earlier, if I want to buy Naspers today, I'm not just paying for the actual Naspers share price. I'm also going to pay brokerage, which is going through my stockbroking account to connect me to the Johannesburg Stock Exchange. There may be VAT, there may be security transfer tax, and not all of these are applicable to retirement funds, but these are the various elements that can make up total investment charges. So to explain total investment charges is to look at the management fee, which is the first fee that we looked at, which is the fee that the asset manager charges to manage the fund. Then you add up all the other bank charges, audit fees, custody fee, trustee duties. That is your total expense ratio. So if you then have your total expense ratio plus any transaction costs, that makes up total investment charges. So this is really the deepest level and the most descriptive fee that you can look at. This fee is not set in stone, because when you transact, I might transact more in July than what I did in June. Maybe in May, I transacted even more. So depending on managers' views, they might be trading more in certain months, trading less in other months. So these total investment charges is not something where we can say it's 0.5% and it's set in stone. You actually know it's after the fact, after you see how much trading actually happened in the portfolio, and there will be some variables that do change from period to period. And total investment charges is something that we all have to become quite familiar with, because this is now the new standard for retirement fund investment disclosures. So from September 2019, the regulations said that, so the Associations of Saving and Investment South Africa, ASISA, they put out a document to say that all ASISA members have to now report on a standardized basis. So all umbrella funds at quote stage, they have to report on a standardized basis what the various fees are. And these fees also include the admin, the consulting, the risk benefits, etc., which I'm not touching on today. I'm simply focusing on investment fees. But on the investment fee element, it's important that we compare total investment charges. So that is what's important. That is the true experience of members as well. So your true experience is not simply deducting the management fee off the gross returns and you think that's what you got, but it's actually deducting the total investment charges from the gross returns. That's what your true experience as a member in these portfolios has been. So the retirement savings cost disclosure, the aim of the stock cost disclosure is, should an institution, so company X wants to now see the various umbrella funds in the market, so they'll get a quote from SURF, they can get a quote from Old Mutual, they can get a quote from Alexander Forbes and the various other umbrella funds in the space. And the idea is not to confuse clients with different terminology and different ways of calculating fees, as it can get very confusing. And we do appreciate that our clients are not all in the financial services sector. They're not all investment fee experts. So you may have, a client that's, brilliant at manufacturing, but they're not, they don't understand the terminology in investment fees as detailed as we do. And this cost disclosure then sets out the calculation methodology and exactly in what format the disclosure has to be. So a potential client, so this company X that does manufacturing, can then receive quotations from the various umbrella funds in the industry, and they can look at all these cost disclosures that are set in the same format with the same calculation methodology, and then they can compare like for like what SURF quotes were, what the other company's quotes were, and what you get for that quotation, and then a client is able to do a like-for-like comparison. So what are then the charges of these portfolios? So firstly, on the next couple of slides, I'll show you the participation fees. So these are the management fees that typically, they don't change unless something from a business perspective changes. So you'll see also that the way that these charges have been set out, which is an industry standard, is to have a sliding scale. So for a very, very large institution that may have R1 billion in assets, it's, theoretically, you wouldn't want to charge them from a percentage of payroll perspective exactly the same as what you would a smaller client, and the reason being is that the rand amount of a massive client will become very, very big. So there is benefits to scale, but we do also feel that the sliding scale fee perspective is also fair from an effort perspective of what the asset manager is providing, managing the money for the purposes of retirement funding. So if we look at the 70 funds, for example, you'll see that the first 50 million has a rate, the next 50 million has a rate, and then the international building block has a rate. So for example, in a typical 70 portfolio, you'll have about 70% that's invested locally and then 30% that's invested globally. So you'll do a weighted average. So you'll say 70% of my portfolio has 0.8565, looking at the first 50 million. If it's a less than 50 million rand client, and then the international side, you'll say 30% is charged at 0.9135. So the weighted average then gives you your participation fee. Then the skeleton range, because it's passively managed, is lower cost. So here you can see that the first 50 million is lower than what we saw, and I'll just flip back quickly so that you can see in the signature and synergy range. So because in these two portfolios there is active management, so you do have the likes of your single managers that have teams of analysts and portfolio managers, those type of investments tend to cost more because you're paying for the intellectual property of these, very experienced teams of portfolio managers that are picking the stocks. But in the passive space, we're simply going into indices. There is no active management and the fees are lower. And then your single managers, you can see the various managers, what they are charging. The money market fund being, of course, the lowest cost because it's simply money market instruments. So these are, as I mentioned, these are service participation fees. So they're equivalent to the management fees when we looked at the various terminologies of fees. But as I mentioned, it's important to look at the total investment charges. So total investment charges, I'll say it again, these are not the same from period to period because transaction costs are different from period to period. So if we want to look at what the actual total investment charges were to the end of the first quarter, the second quarter numbers were still in the process of being calculated. You can see that for your typical 70 portfolio, your standard fee is 0.872, and this is based on the worst case scenario, if I could say, so like the most expensive portfolio if it's a client that's under 50 million. Any client that is bigger will benefit from their scale and their fee would be slightly lower than what I'm showing you here. So the standard fee is 0.872. So once you add on all those audit charges, those bank charges, all those other fees that make up the total expense ratio, you'll see that that then takes us up to 0.983. If you then add in the transaction costs, so the costs of buying and selling some of the equities and the bonds in the portfolio, that then takes us to just over 1%. So this is the total investment charges. So if you were to compare this portfolio to another portfolio, it's important that you're comparing total investment charges versus total investment charges and not the standard or management fee of one portfolio to the total investment charges to another portfolio. In the Synergy range, the fees are slightly higher than the Signature range. So this is the Signature. We now move on to the Synergy. Again, the standard fee for a client that's less than 50 million, 0.872. Add in some of the other charges, the bank, the audit, etc. Add in the trading, takes us to 1.14. And then the Skeleton range, which is your passive range, it's your lowest cost range. There's no active management here, so there's no need to pay for expensive teams of portfolio managers. Here we can see the standard fee is lower. Your total expense ratios then take us up to 0.618. And then if you add in the transaction cost, the total investment charges are 0.698. So if you were just on a fee perspective to choose between the Skeleton, the Signature, and the Synergy, of course, you would then go for the Skeleton. The Skeleton is the lowest cost, but it's also important to look at performance. So, for example, if the Signature range performed better and that performance makes up for the fee differentiator, then the more expensive fee is actually worth it. So it's always important to look at both the return of a portfolio and the fee of a portfolio. Look at it on a net fee basis for yourself before deciding which one is better value for money. And just to caution again, yes, this presentation has been about fees. It is important, but of course, fees are not the only determining factor. Portfolios need to be constructed in such a way that they achieve what they set out to achieve. So they need to achieve the objective over the long term. They need to be managed responsibly. They need to, there's a lot of items to consider in addition to just the fee and the performance. But of course, fee and performance is ultimately what you as a member experience by being a member of the Sygnia Umbrella Retirement Fund. And then lastly, we have included over here the total investment charges of the single manager portfolios. And you can see what the total investment charges, which is the last column, the third column. And you'll see some portfolio managers are more expensive than others, and those are their total investment charges. Again, the lowest cost here is the money market fund. Just being invested in money market instruments is low cost, but these are the portfolios that over the longer term wouldn't beat inflation. So that's all I have for you today. I'm happy to take a few questions, and if there's no other questions, what I'll do is you're welcome to email us afterwards and we'll prepare a written Q&A. Okay, so there's no questions. Thank you very much for joining me. And again, please do send us feedback, and please do send us any questions that may arise after this presentation relating to fees or anything, with regards to the SURF portfolios. We'll be happy to take those questions afterwards. Thank you very much.